So this is who I am. The data sources I'm using here are largely open source through the Federal Reserve Economic Database, as well as data from an organization I used to run called CBRE Econometric Advisors, provided to me via the NAOP Research Foundation. And I want to start with a point that I've made repeatedly since the beginning of the COVID crisis, which is to reflect on how similar today is to 1929. In 1929, in the fall of 1929, equity markets, what we now call equity markets, declined substantially. And at the time, policymakers had little or no data. As a result, we would develop what we now call the national income and product accounts. Lots of interesting work was done in a time where we barely had computers. We learned a lot of lessons from that process. And in my data analytics class and economics in general, we focus on things like natural experiments, randomized controlled trials, and our newest component to the toolkit, algorithmic counterfactuals. But at the time, in 1929, we had a Federal Reserve. It was hardly 10 years old, but they lacked data to gauge economic activity at the time. They lacked data. And in a world where we lack data, we lack information. And when we think about commercial real estate prior to COVID-19, commercial real estate has been disrupted by tech for a while now. Agglomeration economics, this idea of positive network externalities of you and I running into each other on a street, the probability of which rises in dense urban agglomerations that we call cities, drove urbanization and density. And this has been true for thousands of years. If you wanted to think about, if you wanted to consider a thought experiment, you might simply say we're all just randomly or uniformly distributed across the landmass of planet Earth. That is not true, and it has not been true in the history of the species. And that is because agglomeration economics is a critical idea in terms of urbanization and density because of its positive network externalities. Amazon and e-commerce have been driving distributional efficiency of goods for almost a decade. When we think about retail, I believe as an economist, the best way to think about retail is simply as a distribution mechanism, about efficiently distributing goods from producers to consumers. And Amazon is able to do that much, much more efficiently than traditional brick and mortar. And Amazon is arguably now the biggest disruptor to commercial real estate. And finally, co-working. And I will use the word WeWork. Setting aside the issues that WeWork's IPO faced, setting aside what might have been very imprecise valuations of something that wasn't publicly traded, co-working provides the industry optionality, provides the industry the idea of short-term leases, which can be beneficial for both tenants and landlords. The question around WeWork was not the idea of co-working. I believe it was essentially, there were no barriers to entry to what WeWork was trying to do. And you think about the economics of co-working, those economics involve traditional ideas in commercial real estate. Can markets form? And if they form, how do they function? And it's apparent that a structure of co-working will become more important in a post-COVID world. And arguably, COVID will accelerate these disruptions. If you look at capital allocation in commercial real estate, it looks like bond trading in the early 70s. Folks making deals on golf courses. Algorithms will be deployed to assist in thinking about performance, thinking about how to allocate capital. At Econometric Advisors, I used to say, we have 160 observations to help you allocate billions. That's ludicrous in today's world, when we have the potential access to much more data from tech startups in commercial real estate and much, much better algorithms. So my old line about it, we have 160 observations to help you allocate billions, is obviously farcical. So let's think about the current economic cycle, which is stasis. If you listen to my talk over the summer, or if you listen to my talk last March, these themes haven't changed. And yet more than 6 months have passed. It is the basic economics of a liquidity trap, the macroeconomics of a liquidity trap. A world in which traditional monetary policy of changing short-term interest rates in the hopes of affecting long-term interest rates has no policy effect. And so central banks around the world are having to rely on a more traditional function that they had, which is the lender of last resort. In other words, they have to rely on the ideas of Walter Bagehot. When we think about uncertainty, the true definition of uncertainty brought to us by economist Frank Knight, uncertainty is that which we cannot measure. And another policy element in the current crisis is fiscal policy, which is, of course, the idea that John Maynard Keynes put forward in a world of a liquidity trap. When central banks are simply pushing on a string, the last policy component we have available to us is fiscal policy. And as I said 6 months ago, think about when these ideas were created. Walter Bagehot died in the 1860s, I believe. John Maynard Keynes died in the 1930s, I believe, and Frank Knight died in the 1960s. And these are the ideas that we have to reflect on in the current economic cycle, which is stasis. So let's look at some data. You know me, we always look at data. I always look at data. So I want to run through relatively quickly some data. This is the 10-year US Treasury going back to 1990. Point here is that long duration rates have been falling for a very long time. Work done at the Bank of England shows that, in fact, roughly risk-free measures of interest rates have been falling since the 1500s. So we have been not merely in a decade-long or a generation-long decline in long-term interest rates, we have been in a century's decline of long-term interest rates. So long duration rates have been falling. That's relevant for commercial real estate. In turn, long and short-term rates have largely decoupled. This is a graph of short-term rates and long-term rates. You can see from the labels, in red, the 3-month US Treasury, in blue, the 10-year US Treasury, these have largely decoupled, limiting what we used to think of as the traditional role of monetary policy, which allowed central banks to adjust short-term rates and have those impacts flow through to long-term rates. And that ability is broken down. Here's the 10-year, here's the yield curve, 10-year minus 3-month US Treasury. This has been flat or negative for a very long time. We traditionally teach this in a world in which a yield curve has a much steeper slope than is shown in these data. But this goes back to January of 2019, when the yield curve stood at 25 basis points. And it has been flat or negative for a very long time. This is a strong economic indicator in macroeconomics of the state the US economy was in going back to January 2019. Long-term inflation expectations have collapsed again. The dark line is 2%, which reflects the Federal Reserve's stated target of a 2% inflation rate. All of these series you can replicate yourself because all of the series are shown in these graphs. Basically, long-term inflation expectations have collapsed again. And real interest rates, those of us who think about the idea of R star, of a Wixelian rate that would be obtained in a functioning market, are negative. And again, going back some way, we've had repeated bouts of negative interest rates in the US. When people talk about negative real interest rates in the US, when people talk about this idea, will Powell go negative? Powell doesn't have that choice. Real interest rates in the US are already negative and have been negative for some time. If we look at growth in output, in GDP growth, the US is in a deep recession. If you were to annualize the second quarter GDP growth rates, they would rival that of the Great Depression, of measures at least we had before the national income and product accounts at the time. So the US is in a deep recession, and we should not for a moment delude ourselves about that. So what do we see? Federal Reserve tries the old playbook. This is the Fed funds rate going back to 2016. Powell takes over. He begins raising the rate given economic conditions at the time, faces some harsh tweets in 2019, begins lowering rates. The instant COVID hits the US in the first quarter of 2020, he tries the old playbook, reduces overnight lending rates to 0. We have to acknowledge that equity markets have largely recovered. This is a graph of the Wilshire 5000, a broad market index going back to the beginning of the year, declined substantially when COVID began to struck the US in places like Seattle and New York. And it's largely recovered. And in turn, volatility has receded considerably. This is a measure of volatility, the VIX index, going back to before the global financial crisis of 2007, 2008. But we saw levels of volatility in equity markets that rivaled that of the global financial crisis. This is a measure I pay a lot of attention to. This is basically monthly sales of food, beverage, and retail. This reflects Keynes's idea of the paradox of thrift. My spending is your income, your spending is my income. In a downturn, each one of us has an incentive to restrain our spending. And that creates the paradox of thrift, because my spending is your income and your spending is my income. And this is a measure going back to before the global financial crisis that shows just how deeply consumers retracted from spending in the US. Another measure I like to show, this is money velocity, goes back to debates in the 1970s about macroeconomics. You can see just as long-term rates have declined, money velocity, the speed with which a dollar passes through the economy, has collapsed, and it now sits below 1. Employment growth has collapsed. This is quarterly employment growth annualized. You can see I've created this chart going back quite far. You can see in it the global financial crisis of 2007, 2008, relative to what we see today. So employment growth has collapsed. First-time unemployment insurance claims remain elevated, but in March and April of this year, dwarfed anything we saw in the global financial crisis. The worst week we saw in the global financial crisis had about 800,000 first-time unemployment insurance claims. And we are seeing levels, we saw levels close to 7 million in the early portions of the pandemic. And even today, as we sit in October of 2020, these claims remain elevated. Unemployment, often a measure we think about in commercial real estate, because when you think about office, when you think about retail, when you think about industrial, it's the old phrase, butts in seats. It's employed people who occupy office space, who spend at retail, and that generates industrial demand as well. And this is the U3 measure of unemployment, going back as far back as I can, as the US government measures it. Again, relative to the deep recessions we saw in the early 1980s, the global financial crisis, this metric remains extraordinarily elevated. And critically, the labor force participation rate, which measures individuals who are both employed or looking for jobs, has collapsed. This is prime age labor force participation, roughly men and women between the ages of 25 and 59 who are either employed or actively looking for a job. And this has collapsed in the current crisis. We're seeing labor force participation rates on the level of the 1970s, before or during the time when women were entering the labor force substantially, driving up the participation rate. So when you consider the unemployment rate, and folks argue, well, it's come down to about 8%, participation has collapsed. And so that U3 measure almost certainly is not accurately capturing what's going on in the labor force. So what are the macroeconomic implications of this? as I say, it's the uncertainty of Frank Knight and the macroeconomics of John Maynard Keynes. Investors have reflected Knightian uncertainty, this ability not to measure what is going on, with their own behavior. This is money market mutual fund holdings going back quite far. You can see they peaked at about 4 trillion during the global financial crisis. It's now in excess of $5 trillion, sitting in the most liquid asset class one can find. This is effectively cash from investors. In turn, the Federal Reserve remembers Bagehot. This is a measure of the Federal Reserve's balance sheet going well back before the global financial crisis. Prior to the global financial crisis, the Fed held short-dated US debt that it bought and sold to influence short-term interest rates, which we used to think influenced long-term interest rates. When Lehman Brothers failed, when Bear Stearns failed during the global financial crisis, the Federal Reserve acquired all of that debt and expanded the balance sheet from below $1 trillion to over $2 trillion. And everything else you see there is what we called quantitative easing back in the day. And through quantitative easing, this effort to buy long-dated debt to influence long-term interest rates, because the Fed was incapable of influencing short-term interest rates, rose to about $4.5 trillion, where it stood for many years. Globally, monetary authorities had acquired close to $12.5 trillion in nominal debt during that time period. Because it's debt, it ages and it is paid off. So we see that this measure declined a bit. But before anyone had heard of COVID, the Fed was intervening in overnight lending markets, because this time last year, or even going back to August of 2019, overnight lending markets, so-called repo markets, what Tim Geithner called the shadow banking industry, was showing distress. And the Federal Reserve began to intervene by buying up short-dated debt in repo markets. And this is pre-COVID-19. And then we can see the Fed's intervention since the advent of COVID, which is to raise its balance sheet essentially in excess of $7 trillion, trillion with a T. This is unprecedented intervention, and intervention that began well prior to COVID, because the US economy was showing stress before the advent of COVID. So investors remember Knight, Federal Reserve remembers Bagehot, and the federal government remembered Keynes. This is a measure of public debt as a share of overall output, which stands at about 140%. And this is essentially a liquidity trap where we currently sit. So it's actually relatively straightforward to compare 1929 and today, because both are characterized by an absence of data. Knight asked us to consider the idea of distinguishing risk from uncertainty by saying risk can be measured, but uncertainty cannot be measured. And a first approximation today of Knight's distinction is an absence of data. This is a measure of daily US testing for COVID, going back to when we began nationwide testing. And this is now the new sufficient statistic. An idea in macroeconomics, in statistics, that if you could find one measure to summarize most relevant information, we would call it a sufficient statistic. Today, in my opinion, it is daily US COVID testing. And this needs to expand on a policy basis quite substantially. In other words, it should be growing. The growth rate of this should be substantial, and it's not. Which is why 1929 and today look so similar. In 1929, they lacked data for policymaking purposes. Today, we lack data for policymaking purposes. Which brings me now to the sausage making of forecasting, which is to combine historical data with an algorithm and some assumptions about the future. The assumptions I've made, and a colleague I have who works with me on this, are consistent with academic forecasts of economic recovery, but frankly not consistent with Wall Street forecasts of economic recovery, which have tended to be optimistic. We think there'll be roughly an annual growth rate of about 4% in 2021, 3% in 2022, average unemployment rates of 5.5% in 2021, 4.5% in 2022, and inflation that isn't going anywhere. And we've conditioned these forecasts. We've made these forecasts conditional on an idea that we have an efficacious and widely distributed vaccine for COVID-19 within about 9 months. So you combine the CBRE data with a sophisticated machine learning model and these assumptions, and we get this. This is our forecast for office net absorption going forward. The green line is the prediction. The black line is essentially what's been realized. We forecast 1 quarter ahead. You can visually compare the green and the black lines and have a fair amount of confidence that the forecast error here is small. And so we essentially think the contraction in net absorption, what we economists just call demand, but oddly real estate people call net absorption, will continue to contract. But all's not lost. Based on our macroeconomic assumptions, we think that this is the time path of absorption going forward. It will continue, it will remain negative for a period of time, but it will recover. The black line is the most probable forecast, and then we give you some sense of forecast uncertainty with the 2 green lines that border the black line. The best way to think about this is to think about policy. If we manage to get the policy right, then we could be on the upper green line. If we don't get policy right, much more probable that we're on the lower green line. But I want to talk and round this out by addressing the challenges of forecasting in a pandemic. In this pandemic in particular. Again, folks who have heard me talk have heard me say very forcefully that this is a natural disaster. This isn't like the global financial crisis. This is a natural disaster that affects human capital. And so the pandemic is both a demand shock and a supply shock. And that is challenging. From a statistical point of view, we're faced with a lack of data, whether it's the lack of CBRE data or the lack of COVID-19 testing data. We live in a world of heightened Knightian uncertainty. And why that is important is from a statistical perspective, we think about what is called random or stochastic regime change. And we have to begin deploying more sophisticated models, Bayesian models, Markovian models, hidden Markov models that allow us to better deploy the limited data we have with the more sophisticated algorithms that we have. And that's a challenge. And then finally, we wind up with Amazon. We wind up with the secular changes that have been going on in the industry through e-commerce, through co-working, driven, I would argue, by Amazon's revolution in retail. I was quite surprised to see some of the preliminary data on industrial absorption recently. And when I talked to my industry sources, they said it's all Amazon. Amazon is currently making a strategic play to lease a lot of space because they think COVID-19 is the accelerator for e-commerce that they've been waiting for. And they're going to opportunistically acquire a fair amount of industrial space as fulfillment centers for that reason. So industrial continues to outperform my expectations, the industry's expectations, because of this basic idea that retail is just a distribution mechanism. And Amazon and e-commerce is revolutionizing that distribution mechanism, especially as they co-locate near dense urban clusters. All of these represent challenges of forecasting in a pandemic. But that's what makes this fun. So with that, we'll go with questions as long as you want to ask questions. You can just ask questions in the Q&A box, and I'll do my best to answer them. So the first question is, what is my take on the recovery of the job market and workforce participation? The Keynesian idea of doing something in the Great Depression was the correct one. Keynes was very worried about the idea of what we now call secular stagnation, that we would wind up in a world of high unemployment and low growth, but that central banks didn't have much influence on changing that. So the last policy available to them was in Keynes' view, was fiscal policy. I do believe that we need to continue aggressive fiscal policy. Because that helps essentially to replace income that is lost from short-term unemployment, even though that may continue to have a depressing effect on the labor force participation rate. Undoubtedly, part of the decline in the labor force participation rate is the fact that schools are online and remote. And families are having to make a decision about whether somebody stays home with the children in a world where the schools are online. If we have an efficacious and widely distributed vaccine within 9 months, I'm fairly confident that the labor force participation rate will begin to rise back to levels we saw before the crisis. Recognizing that there are some demographic issues with an aging labor force, but as the millennials are coming into the labor force now, and that will help to drive labor force participation rates. Also a great question. More specifically, as students, how would this recovery impact us since we are likely to be looking for work within the next year or so? Also a great question. My dissertation work actually looked at long-term wage impacts from early career adverse implications. I called it the long-term effects of youth unemployment. You can read the work if you want to. I found nothing. Generally, young people entering the workforce are not impacted in the long term based on where the labor market is at a current period of time. So there's not a lot of evidence to suggest that there are so-called long-term earnings losses depending on when you enter the workforce. And then I contrast that against two things. One is you are in an industry that is probably the last asset class that we will address. The first asset class becomes the last asset class. Commercial real estate, if I were entering commercial real estate, this would be the time I want to enter it, when it's distressed. If we look back to individuals who entered this industry in the late 1980s, early 1990s, they have done extraordinarily well because they entered the industry at a distressed time. Number one. Number two, and I teach this in the data class, there's a lot of evidence to suggest that there are strong returns on investment to education. And I'm not just talking my book as a professor here. I can back that statement up with evidence. So 3 things. One, my own work that doesn't show much of an impact on long-term earning capacity given short-term dislocation. 2, entering the industry when it's distressed is probably a more interesting time than entering it 4 or 5 years ago when everything was performing well. And 3, rates of return or return on investment to education is very high. Next question. The Depression lasted until World War II. How long do you think this disaster will last? And will it take something dramatic? So in truth, the Depression did not last until World War II. If you look, as we constructed these data sources, the US economy was recovering by right? If you date the Depression, the commencement of the Depression to 1929, the US economy was actually recovering fairly well by 1934 and continued to grow until about 1937. But there was a concern at the time about debt, and the US fiscal response began to retrench in 1937, and there was a downturn then in 1937. Obviously, by 1939, things had changed. The fiscal stimulus had returned because of the US, although it had not entered the war by that point, obviously. The US economy was beginning to pick up again by 38, 39, 40, and then World War II fundamentally changed the dynamic. So it wasn't only World War II that helped to end the Depression. It was basic Keynesian fiscal policy. So another very specific commercial real estate question. Given rent collection in commercial Class A office space are hovering around 90%, what is the outlook for BNC buildings? Do you see further separation of asset class? So this is really, how much more, I would argue, how much more heterogeneous does this asset class become because of this? And I think potentially much more heterogeneous. We could actually see rent levels rise in the next year, but that's in places like New York because of the level of differentiation in the quality of New York office stock. Right? When I teach, when we sit in Shack, we are not sitting in Class A office space at Shack. We're a university, and we're not willing to pay. But you tour space in Hudson Yards, you tour space in the World Trade Center, the space that's, I think, going to be delivered in One Vanderbilt will continue to drive that heterogeneity. So on average, essentially because of survivorship bias, we could see average levels of rent rise. At least, it won't necessarily be net effective rents. It'd be stated rents, but we could see those continue to rise exactly because of this heightened differentiation, heightened heterogeneity in the office stock that we have in New York, in other major urban cities in the US. Oh, let me go to, sorry, let me. So a very technical question that I will get to in a moment, but I want to see if there are any more. Okay. Very good technical question about the so-called statistical model that we use to do this. How do you make sure the model did not overfit? Excellent, excellent question. Difficult to address as a general matter. What we don't do is re-estimate the model every time we get in an additional quarter's worth of data. In fact, when we examine the statistical estimates, the parameters of the model, they're very stable over time. So what we don't do is re-estimate the model every time we get in another quarter of CBRE data, which would drive us in the direction of probably overfitting, of making the most recent quarter of data have an outsized impact on the results that we get. So that technically that's how we do it. And I hope that was a sufficient answer to your question. Some other questions. Oh, an anonymous attendee. Those are always fun. Based on your research, what happens to salaries for mid-career CRE workers that are removed from the workforce for a period during this recession? What is the lag moving forward once you re-enter the workforce? My dissertation, so I can't address a question this specific based on my own research, and I'm not aware of research that is capable of addressing this question. What I thought about in that line of research was an exogenous shock to a young person early in their work life, where they had opportunities to get additional education or additional training. And I built out a mathematical model around that, and then built out a statistical model around that. And what I found was, faced with a shock early to the work life, individuals tended to get more schooling than they would have otherwise, or tended to get more training than they would have otherwise. And that essentially was what I called an optimal catch-up effect, an optimal response to a shock. You get more training, you get more schooling, and that compensates for an adverse impact. And it was essentially a compensating differential. And the statistics I did highlighted that that was true. And through that additional training and through that additional education, I argued that the impact of early adverse shocks to the work life were mitigated. But I can't address anything as specific as commercial real estate workers. Another question from a former student: what are the long-term effects of lease terms as companies move toward flexible working from home policy? Will they dip in return? My probabilistic view long-term is that we will return to the office, that the economics of agglomeration will dominate everything else we see. And that the office isn't dead. Short term, we may have to de-densify what we have de-densified. Longer term, as a probabilistic judgment, I think that the economics of agglomeration that have been in place for thousands of years will reassert themselves, and that we will return to the office partially as a social matter, engaging with colleagues in person, but because of this idea of agglomeration, the economic efficiencies driven by agglomeration, which tend to get passed on to individuals with higher wages. So what I would say to anyone in the industry now is reflect on the need for safety, but don't think that this is a long-term equilibrium, because I don't think it is, as a probabilistic judgment. Again, from our one of our anonymous attendees. Two separate questions that came in. Let me address the longer one. When do you think we will have a better sense of the bid-ask spread between sellers and buyers of institutional Class A office properties? Well, I'll just use New York, in New York. Again, that's a question around the lack of data. There aren't a lot of transactions occurring. We don't have a good sense of the bid-ask spreads currently because there's not a lot of price discovery going on. Our forecasts were conditional on an efficacious vaccine within 9 months. I think we will begin to see by the second quarter of 2021 much more price discovery. Don't forget, the demand for the physical asset is driven by these long-term secular changes. The long-term decline in interest rates, which arguably is a long-term decline in a risk-free rate, a desire to hold the physical asset because the risk and return profiles look better than the risk and return profiles, say, of a bond, notwithstanding the illiquidity, and the ability to drive performance by owning the entire asset. I say this very honestly as an economist. I remain incredibly bullish on the industry long term because of the nature of the physical asset. Algorithms have driven away bid-ask spreads in equity trading and bond trading, and they will shrink them more in the trading of the physical asset. But the physical asset is highly differentiated. It's not like buying a 10-year US bond. And that differentiation allows for outsized performance given a risk profile. Another question, what is my view on the demand for suburban office space? If I think about that question as a matter of history, suburban office space is relevant. I don't think we're going to see the sort of co-working structure in suburban office space that we potentially will see in urban office space. But in the short term, I would expect suburban office space to perform relatively well as we do create a sort of de-densified hub and spoke structure. RXR, Scott Reckler talks about this as sort of hub and spoke idea of using de-densified suburban office space. But my algorithm learns from the past, and the economics of agglomeration have been with us for 4,000 years. And I'm willing to rely on a daily data set going back 4,000 years than I am on speculative conjectures about permanent de-densification as a probabilistic judgment. Good. Any additional questions? If not, I'm going to end this session. We continue to host these faculty sessions for students, just as we've continued our remote REIT and capital markets series. We really want to stay engaged with our students. We really want to stay engaged with the industry. So notwithstanding Zoom fatigue, we want to stay engaged with you. So folks know my email address. The slides are on my GitHub repo. Feel free to shoot me any messages, any additional thoughts. Otherwise, I'm going to end the meeting. Thank you so much for attending.